Mehrbun Irani of Nirmal Bang Securities joins us with his perspective on trade. Mehrbun, it's good to have you on the show. What is your own near-term assessment of how things will pan out on the index first, and then we'll talk about stocks?
Well, I think optimistic, confident as always that we are biased towards the higher side. I think there is a big lag, which I always believe, between market performance and overall economy. So if somebody tries to argue with me that the economy has still not taken off, I agree, the economy has not taken off. But whatever is happening a little too late, I think it's exceeding the expectation of the most ardent optimist. And I'm talking to the part towards fiscal consolidation. I think everything, raising of revenues to trying to hit subsidies, I think everything, right moves being made by the finance ministry and the Prime Minister. I think that itself is the single largest factor for people to remain enthused that we could move higher. Inflows are continuing. Unfortunately, what has happened in January is that the stocks which everybody, virtually everybody on the street, every fund manager on the street was underweight, starting from Infosys, ONGC, Oil India and Reliance Industries. They have outperformed by a wide margin, leading to the indices going up, while the favorites of the market like the HDFC, the levers, they have come down, even the Lupin, to some extent the ITC. I think this type of stocks have underperformed, which were the favorites of everybody. So I think fund managers and most equity schemes of mutual funds are going to underperform the indices by a wide margin in January. Coming back to the markets, I think, fingers crossed, as regards RBI cutting rates, quite confident, and I've been stating this every time I come on your channel, that I'm quite confident this budget is going to be a real good budget as far as the capital market is concerned. Savings are going to be incentivized so that people don't put their money in gold. Certainly that is going to happen, and we need to accept the fact that if this government needs to come back to power in 2014, they have to kickstart the economy. So I don't expect too many dollops for the voters, considering it's the last budget before the election, like what most people believe. Dollops anyway for the voters come in every budget. I think this time it will be very balanced, pro-corporates, pro-capital markets, pro-savings, and I think that should be looked at very well by the markets. I think fiscal numbers also, which are very, very important, I think will be under check. So all said and done, I think the market could give a thumbs up to the budget. On the ground, things are still not improved. I think land acquisition, environment clearance, the government needs to do a whole lot of things on that, because till the time the economy doesn't kickstart, the lag will only widen. What I'm trying to say, the markets will keep on going, fundamentals will not improve.
Right.
So I think somewhere we need to be a little bit alert. Somewhere we need to learn to accept the fact that we need to book profits. And I think the biggest problem for the market, if any, in February could be the fiscal cliff. The debt problem of US could provide to be an accident for global equity markets.
Right.
India will not be an exception.
Well, that's a fair point. And what you flagged off, I think, all of them are extremely valid and crucial points. But I would also like to draw your attention to the market pattern. Look at the news flow. In last 3 weeks, news or good news has come from unexpected pockets. First it was Infosys, then we got a diesel price hike, then we got a surprise from Reliance Industries. We got a telecom tariff hike yesterday. But if I look at benchmark indices are looking slightly rusty. The market breadth has caved in, and the desire to trade long is not there. News flow is strong, but momentum is missing.
True, I think it's a rotational shift, Nikunj. That's exactly what I said earlier, that I think the big question marks that people had in the minds of the oil and gas sector, virtually nobody. I think, let's be honest, just a few months ago we were criticizing LIC for investing in ONGC, the biggest gainer. Infosys, 9 out of 10 fund managers on the street were underweight on the particular stock. And the biggest gainer in front on IT stocks. Reliance Industries, when is the last time when you have heard somebody talk positive about the stock? The stock has been a decent performer. So I think that is where I think I would use the word, grapes are sour. We all feel that, market bad gaya, unfortunately, things are just, but still the indices are not moving up. I think that, yes, what you are saying is 100% true. Because HDFC has given up nearly 8 to 10%, Lever has given up nearly 20% from the highs, and that is taking care of the indices not going up. So I would say it's a rotational shift. Now what happens ahead, whether we'll see a 62, 6300, is definitely very much possible, because you still have the RBI yet to cut rates. You still have ICICI Bank to perform. You still have SBI coming out with numbers. L&T is there today. If there are some positive surprises here and there, for all you know, we could be discussing 6200 Nikunj. But whether one should buy into the market just for a 3, 5, 6% appreciation more on the index, I don't agree on that particular thing. I think yes, you should not invest just because the indexes are going to go up. You need to be very stock specific, and therefore I personally feel some of the stocks which have relatively underperformed could possibly be the reasons for the indices seeing slightly higher levels before the budget.
Right, Mehrbun, a quick call really on some of the index stocks and the earnings that we saw, especially on the consumption side. What's the call on the likes of an HUL?
HUL, I think, very disappointed. Volume sales very muted, 5%. I think the royalty issues, I think everybody has discussed it by now, but my personal view is that is Unilever going to contribute more to improve the business as far as Hindustan Unilever goes? If the answer is yes, they have a right to take royalty. But the point is, what were you doing for so many years? I think somewhere along the line, the perception is going to come among investors that even the other MNC Indian companies will be having to pay more royalty to the foreign counterparts. I don't know whether that will happen or not, but as far as lever goes, I think the volume growth of only 5% is a big negative in my mind. Now, whether I should exit lever at this present level, I think somewhere at 430, 440, 450 levels, I think most of the negatives, including the royalty payment, could possibly get built into the price. So I think the way the stock has fallen from a 580, 570 levels to the present level, considering it's fallen by more than 20% over the last 1.5, 2 months, I think makes me feel that at 450, 455, I'm not going to advise investors to exit the script now. I think a little too late.
Tata Motors will fall today, but the question is, by how much?
The point is, if you ask me, I think on the ground, the scenario as far as the whole auto sector goes, and I'm talking of four-wheelers right now, whether it's passenger, CV. CV is in absolutely bad shape, and I don't see it improving for the next 2 or 3 quarters. The passenger car sales, whatever the numbers may look like, the fact is on the ground things remain bad. And I have got very influential sources in the industry with whom I regularly converse, and that's the feedback I'm getting. The things are just not improving. But if you look at the auto index, I think outperformed by a very wide margin. So somewhere I think it's gone through the roof, and I think valuations have gone haywire. Now, should one possibly exit the auto stocks? Certainly not buy, not at the moment. And I've always stated that the dark horse in this pack is Tata Motors, and I don't consider Tata Motors to be a domestic company any longer. While they have their presence in India, I think we need to accept the fact that nearly 90% of the bottom line comes from JLR. And that is where I remain very positive despite the statement coming from the management. So yes, the stock could definitely come down. 5, 7, 8, 10% lower from your brokerage houses will come and possibly do a downgrade on the stock. It's certainly going to happen. Tata Motors has shot up very sharply. It's really outperformed by a very wide margin, even the other auto stocks. So at 310, certainly it's not a buy, at least not from the short term. But if this correction, which is likely to happen following the news which you read, I think if we see it coming to maybe around 270, 280 levels, I think a fresh relook at the stock and a re-entry could be made according to me. I remain still very positive on Tata Motors as possibly another 15, 18 months story. And I'm very confident as the slew of models which are going to be introduced under JLR. And I'm quite confident of the fact that somewhere, maybe 2 years later, Europe and China, the biggest markets as far as JLR goes, should improve. So I remain positive on Tata Motors for the longer term. The stock has gone up. I was never too enthused to recommend the stock at 310, 325, 330 levels. And I always stated that as and when the stock corrects, one should be looking at it. I think the news which you read out should prompt a correction, and maybe at 270, 280 levels, I think I will come back on your channel and possibly say that Tata Motors is a stock which one can be looking at positively again because the valuations have come down.
Bermun, but which is one large cap stock where for the year 2013 you are allocating disproportionate amount of money, where you're okay to, let's say, invest 6 to 7% of your total portfolio?
I think we continue to remain with, I won't use the word defenses, but companies where we are quite confident that, I am quite confident that 2013 is going to be a challenging year on the whole for the global markets. India will outperform. So while there could be trading calls here and there among frontline stocks, I think the stocks in which we remain comfortable include Bajaj Auto, HDFC Bank, and Lupin.
What about media stocks? Sun TV, Dish TV, Zee Entertainment?
I think I looked at the numbers quite closely, and I think considering the fact that all of us without exception have suffered so heavily in somewhere in 2004, 2005 when there was a frenzy for media stocks. that I'm one of the last few who are still not enthused to go back to them. So I still remain very underweight on this entire sector, if you ask me. The stock which I think I'm quite comfortable possibly looking at, if I'm forced to buy into a media stock, would be Z. I think Dish TV numbers a little disappointed. I have always liked the stock. I have said it's a lovely concept stock to buy into. I have invested in the stock for my clients right from the time it was around 20 rupees. But the numbers which came right now possibly disappointed me by a very wide margin. The reason is the content cost has gone up. Depreciation has taken off. I think on the whole, ARPUs are not improved. So Dish TV, I also feel there will be an equity dilution coming somewhere over the next 1 to 3 quarters. So near short term, I don't see the stock price doing too many things. Longer term story remains intact because digitization has just taken off in this country. So Dish TV over the longer term could outperform the peers in the industry as far as ARPUs goes. But this quarter numbers which just came out yesterday or day before yesterday, I think reasons enough to be disappointed. The stock could underperform. So in the media pack, I remain underweight despite the fact that large number of people in my fraternity have started looking at this sector very positively. I think I'm not yet ready to bite into it, despite the fact that Sun TV and Z reported numbers better than expectations.
We are looking at Tata Motors on the pre-open rates coming into about 286. How much downside do you expect for the stock in today's session?
I think I mentioned that about 275, 280 would be a level I would look at, and I completely endorse. I think Nikunj more or less said the same thing which I had stated. The stock had run up very sharply. It was over-owned. Somewhere I had always called it a dark horse, and I was feeling stupid that I should have been more firm in my, I should have been more convinced and recommended the stock a little bit more strongly over the last few years, because Tata Motors has really outperformed. Today, you talk to every second fund manager, I think he talks of Tata Motors as his prime pick, top pick in the auto sector, mainly because of JLR. And when you have I would not use the word warning, but when you have management coming and stating in the open that JLR things are not going to be as good as what people expect, at least for the next 1 or 2 quarters, you will see a sharp fall off as far as the share price goes. The pre-opening is suggesting 285, 286. I think 270, 275, 280 would be a level I would definitely look at, because somewhere you need to accept the fact that, okay, even if I buy at 280 and if it falls another 15, 20 rupees, I'm going to see a price much higher than here over the next 12 to 15 to 18 months. And that is what will prompt me to possibly recommend to our clients to buy into Tata Motors maybe at 270, 75, despite what the management has stated, despite the stock being over-owned. And technical factors will come to the fore. So maybe I'm not saying 270, 275 is going to again become a 300 in a hurry. It may not happen. It may take 1 to 3 quarters also. But over the next 12 months from 270 to 275, I see a decent 20, 30, 40% being made in Tata Motors again.